The geopolitical situation going on right now is genuinely impacting oil. It's just almost like whoever kind of feeds these headlines and things that generically can be understood in the macro community isn't doing a very good job of saying this is actually having a very serious impact on oil, and you should be worried. Hello and welcome to another episode of World of Oil Derivatives. I'm Greg Newman, Group Chief Executive Onyx Capital Group, and I'm joined today by Martha Dowding and James Brody. So we've reached a key point in the year, which is post the FT Commodities Summit in Lausanne that has just come to a conclusion. This is where executives of trade houses face the press and set the tone for how the year has gone so far and where it's likely to go for the rest of the year. It's an important inflection point as Q1 is out of the way and traders have largely staked their claims in the market and are looking to drive consensus. This time, there is no consensus. The market seems more interested on how much money the trade houses are making rather than what is in store for us, and talks on sanctions and inflation or a possible wild ride ahead in markets were muted at best. This is quite telling in and of itself. The trading community and even the research analyst community and banks don't seem to be interested in stirring up hype like they have done in recent years, even though the favourite talking point of $100 per barrel isn't far off at all from current prices. So possibly they want to tread carefully because of the unpredictability of bull markets in recent years, or is the market just being downright complacent, which is usually the perfect conditions for a tail move. Either way, we are here to dive in and explore the recent market moves and reactions. And Martha, could you start us off?
So last podcast, we were below $89 a barrel. And since then, we've had an exciting week. Brent has gone up to within touching distance of 92, but not quite, and down below 90 where we are now. It seems kind of supported at these levels. Prices are happy to kind of oscillate around $90 a barrel, kind of waiting for more cues. There's been lots of news in the geopolitical sphere as well as the markets and economic news. In terms of the stats, crude-wise, we saw a 5.841 million build in the US stocks compared to an 800,000 barrel predicted build. This was fairly expected, as this is usually the second, in terms of seasonality, this is usually the second largest build of the year for this week. Distillate saw a build as well, unexpectedly, which was really poor for the market. But Cushing did see a draw of 170,000 barrels, which is another draw, which is good, although refinery utilisation did drop by 0.3%. In terms of the other data, CFTC data for the week to the 2nd, which is when we saw this rally, saw an amplification of the previous week's bullish positioning. So long positions increased by just under 10.6 million barrels, around 3%, and short positions decreased by 1.7%, about 1.2 million barrels. So now we're at the highest net positioning by money managers like funds since September 2021. The market is bullish, funds are bullish in Brent, and Prodmark players, on the other hand, took the largest amount of positions off since the week to January the 2nd, so before Christmas, taking off like the long position took about 9.4% off and short position Prodmark players took about 7% off.
Yeah, I think that plays quite nicely into the narrative I kind of started with, which is I don't think anyone's getting too overexcited, and which I would never have expected, because people tend to love getting excited about bull markets, and as I was saying, heading towards 100, it's usually okay, here we go, and everyone gets riled up. But in the Commodities Summit, like I was saying, I was just at, it was very muted. The panels were muted, mixed bulls and bears. The trade house CEOs were 90 seems around fair. It was only actually head of commodities Seb at Citadel who outright said, the market is looking extremely tight potentially, as in the forward market. And I think we're in that camp. I think it's very similar to 2022. That's what we've said, and looks like it could be worse because there's sanctions actually biting in Russia this time, term contracts coming to an end, things like that. But yeah, the positioning is, okay, the hedge funds, I think week on week, they've had a bit of a lag, right? They were not so bullish and then kind of have gotten bullish lately. And at the same time, this is where the Prodmarks, so the trade houses, the majors, starting to take profit potentially, or at least taking off length. That seems logical with what you're hearing. It's playing out in terms of the sentiment, but it's strange because we still feel we have everything geared up towards a monster rally. So I think there's a lot to unpack. The first immediate thing, though, is the deal is pretty unexpected, right? The crude rallying so much in terms of such a big build, unexpected builds in gasoline, builds in distillate, I think NGLs as well. This is all implied demand being really low in US. Maybe something James can comment on. Might just be a flash in the pan, but it was substantial. But that aside, we just look to be really gearing up to a very, very tight market, like Seb said. So I think what I wanted to unpack was the macro headlines and the macro oil headlines. This is the final piece of the puzzle. If this could have been achieved by convincing storytelling in the last couple of weeks. The $100 per barrel thing isn't new, but I think if you really get into things and you put your passion behind it, like usually banks and research analysts do, I think people would be getting very excited right now, and you would see it in the positioning. It's a bit of a circular thing I'm saying, but it just seems muted. So maybe we could dive straight to, US implied demand. Is that a flash in the pan economically? And anything else? Maybe we just summarize what's going on in macro right now, James.
Yes, certainly. We've seen actually the data in the US continues to come out on the strong side. We spoke last week about manufacturing PMIs in America and China surprising to the upside. Last Friday we had the US payrolls came in much stronger than expected. Market was expecting 214,000 jobs created. It came in just over 300,000, and the unemployment rate is incredibly tight at 3.8%. So the US economy, we're not seeing signs of any slowing there. It's ticking along very strongly. And then yesterday, suddenly we had the CPI data, which came out, and this was the really big market mover. It came out above expectations for the third month on the trot. The year-on-year CPI is at 3.5%, was expected to be 3.2%, so it's not getting down towards the Fed's target, 2.5%. We saw a huge move in the bond market, 2-year yields up 23.5 basis points, that's 4.9% move on the day. And to put that in perspective, the 5-year yield had its second biggest move in 10 years. So suddenly that's made financial conditions a lot tighter. Beginning of the year, I keep saying we're talking about a hard landing, and the market was pricing in aggressive Fed cuts. Now suddenly the OIS is pricing just 41 basis points of cuts this year. That was 65 2 days ago. So the US economy it's running strong. Also on that, actually, that was compounded last night. We had a bond auction, a 10-year auction, which went really badly. So even though the 10-year yields have rallied 70 basis points since the beginning of February, people aren't looking to buy them at the auctions. The tail of 3.1 basis points was the third biggest tail on record. So this goes back to, slightly off what you asked me, but goes back to what we were talking about last week, is there's not the appetite to buy US government bonds. And
because people think the interest rate's going to go down.
Here, yields keep going up. So it's partly what's driving the interest towards the gold market.
Yeah, and I mean, there's a lot of hot talk about the dollarization, the endless debt cycles. Now the U.S. Treasury, the Fed, having so much to pay back, it's getting pretty astronomical. But at the same time, the governments don't seem too scared about it. And then people people just buying European bonds over U.S. because of the yield situation. No,
definitely. We have the ECB coming out this afternoon. The market seems certain that Christine Lagarde was going to have to prepare the market for a cut at the next meeting in April.
Right.
All of a sudden now the ECB is in a tighter spot, because if they cut and the Fed aren't cutting, all of a sudden euro-dollar will go aggressively lower, and that will import inflation back into Europe. So that's the big concern there. Yeah. But one other point I should bring up on the growth scenario is overnight a couple of banks have revised up their GDP forecast for China this year. So again,
this is massive, right? And again, it was something in the conference. It was, but the China data looks so bad. And I think it's just, people love talking about lagged data. It's got to be about, we know all this stuff, and even the data you're talking about right now is still lagged, right?
Absolutely.
And so we're going to see the impacts of the market now, or at least the physical markets now, and we'll get the information for what kind of led to that a few weeks later, even a month later.
Yep.
So with China, it's the same thing we've been banging on about, right? So yes, it's been poor, very, very poor. And at some point, if that's in the sentiment of every trader, be it equities, bonds, of course, but also commodities and even the niche oil contracts, at some point it has to price in the level by definition. And everything we're seeing, at least on the oil trading side, is it's a lot less bearish than it was, which is a bullish thing. And then there seems to be more momentum with the macroeconomic stats, like you're saying, right? So
absolutely, and economists are always slow to change their view. They don't have a P&L, so it's not black and white at the end of the day. The only thing, if their view's wrong, it's bad for their reputation. So they'll typically stick with the view, but we can see the data changing quite clearly.
And this was all a little bit in slow motion, but at the same time, the state hedge funds came out and were buying in China. I think there was talk about that. There was a lot of rhetoric coming from CCP. I think they made it pretty clear that they're going to do something about this and they're going to address it, and people just didn't believe them, I guess. But we are seeing the impacts of stimulus, right?
Yep, they've set aggressive inflation targets. They want the CPI at 3% this year. It's 0.1 that came out overnight. They want 5% growth, and they'll do what they have to do to achieve it.
Well, that's pretty massive, I think. Okay, so that's the backdrop of macroeconomics. Ultimately, looking bullish. Definitely bullish. US and China bullish. That's bullish oil, no matter where you put it. And from a supply side, we are looking very strong. So we can get into a bit of the minutiae in a bit, but I guess, Martha, the last piece of that puzzle where I'm saying if the macroeconomic outlook's looking strong for US and China and you're looking to buy oil, you're in this tricky situation where if oil gets too high, you start to think of inflation, you start to think that's probably quite bearish for the macroeconomics. But if there's geopolitical scenarios, that seems to trump all for the big hedge funds and the big people carrying, huge amount of money flows that they can put into ETFs, which find their way into the oil market. And we've had a lot of withdrawals from the USO, from the Wisdom Tree ETF, like big kind of redemptions in essentially buying in their long positions in oil, and so they've effectively been selling despite all that's going on. So geopolitically then, what do you think can stir, or there's a lot going on, right, to potentially stir people up again to enter again?
Yeah, I mean, after there was a bit of a softening in the middle of the week where Israel pulled some troops out of Gaza, there has then been kind of a scale up in the rhetoric between Iran and its proxies and, well, essentially the US. The commander of the Iranian Islamic Revolutionary Guard Corps Navy has threatened to close, well, he said he's not going to close the Strait of Hormuz, but that he could, which is pretty drastic to threaten 20.5 million barrels of oil going through that every day.
But it's their card, right? That's their...
Yeah, that's all they can say, really. Yeah. They've said it before.
Well, people know that's their trump card.
Yeah.
You got, Russia can say nukes, Iran can say closing the straits. So it's just saying, look, we're going to start using our levers soon if you keep messing around, type thing.
It's interesting, though, because they've kind of also countered that by shipping more oil in the first quarter than any period since the sanctions in 2019, shipping over 1.5 million barrels. So they'd be really shooting themselves in the... I think it's a funny thing to threaten when you're at the same time, shipping as much oil to everyone all of the time, but...
Well, I think it's about retaliation. Ultimately, they know. I think all the evidence has been... I'm not trying to say I disagree, actually, but it's just that given the Russian pipeline's been taken offline and how much of a big impact it had on the whole Western economy, that's kind of why it's not just a bigger threat in terms of, obviously it's a big deal no matter what year you say it, but now they're saying it being like, look, you just got screwed over by this type of thing in 2 years ago. It's going to happen even worse if we do it. I think that's recently in people's minds, and I think it is quite a good threat.
Yeah.
Do you know what I mean?
Yeah, totally. I think as well in terms of like scaling up the rhetoric, there's been movements around the sanctions, as you mentioned in the introduction, that could end up with more sanctions being put on, more of the secondary sanctions. There's been 100,000 tons of Urals being loaded into India after 36 days, floating outside of India. There's been more acknowledgement of the secondary market for oil under the sanctions. In the conference in Lausanne, where Jeffrey Pyatt, who is the US Government Assistant Secretary of State for Energy Resources, said that you've got one market, deep and transparent, well integrated with the global economy, and another which is shallow, opaque, and unreliable. So kind of acknowledging the scale and the kind of presence of the secondary market around the sanctions kind of almost suggests they're willing to put more sanctions on, the more sanction avoidance there is. And there has been loads of news of sanction avoidance. More Iranian oil en route to Bangladesh. Turkish diesel and gas oil exports loading reached a record high of just over 1 million tons in March. And Russian diesel and gas oil exports to Turkey also reached a record high. So you can see that it's pretty transparently going around these sanctions. And there's always going to be a way around sanctions, and there's always going to be more sanctions to be put on. So I think it's kind of this like scale up situation where the more news especially and the more acknowledgement there is of this sanction dodging, the more secondary sanctions there could be put on.
Yeah, and there is evidence that, you know, like the floating storage has been in place, and even for Russian oil now, and sitting in land storage because they can't export it. That is a very clear sign that the sanctions are genuinely working. It's interesting because, so when you get a reduction, in a seemingly a taming rhetoric of the current Israel-Gaza situation, flat price sells off, right? People immediately sell. We had like $1.50 sell-off when there was a headline about there potentially being talks. We then had the reverse last night because there was talk about Iran retaliating to the Israel kind of and Iranian embassy situation in Syria. So all of a sudden, people do the reverse. So it's quite evident that that is still in people's minds. That's, when I say people, I mean, going back to what I was saying in this piece of the puzzle, the physical market already knows it's tight. The macroeconomic market knows it's strong, US and China. It's like the geopolitical situation for oil, for financial kind of hedge funds and pensions funds. They seem to react exclusively to these kind of events, and it needs to be immediate. It needs to be headline driven, it seems. And they're kind of ignoring the geopolitical picture that's going on, that this time round, we always say the opposite. We always say geopolitical things in the headlines are just a bit immaterial to the physical world. The geopolitical situation going on right now is genuinely impacting oil. The Ukrainian drone strikes taking off real oil, the secondary sanction effect. And then, of course, the talk about Hormuz Strait, that's not a, Israel, Gaza, Hamas situation, that's not very close to oil at all, but the Straits of Hormuz is like very, very directly impacting oil. So it's just almost like whoever kind of feeds these headlines and things that generically can be understood in the macro community isn't doing a very good job of saying this is actually having a very serious impact on oil, and you should be worried. I mean, I'm talking very much because I believe that the market should be higher, but even if you were thinking objectively, I think people can agree that it's not really been, there's not much alarmist talk, which is the opposite of what you usually get. Yeah. And I think what I would say is, to further back that up, is the option situation. So call options are starting to, there's a lot trading lately. It was brought up again in the last few days. And it makes sense, right? Because volatility is still cheap. And I'm talking specifically oil. And we've talked this year about it being actually a good trade to be short volatility at the beginning when it didn't look like much was going to happen. And then now it's almost like the market's holding on to this short volatility narrative, which is very dangerous, very, very dangerous. And I think traders are starting to take notice, and they're starting to invest in these calls because there is genuine physical and geopolitical risk here that it's kind of just really, I don't really understand how that's happening. But I think you said it quite well, James, which is macroeconomics, economists, and their thinking, which I know you're saying because they don't have a book trading, but actually if you think about funds and slower moving funds and actually slower moving oil companies, they're the same, right? They can't react to every little event. They've got to take a long-term view, and they're probably still thinking, yeah, but long-term 90 is fair. Producers are going to be producing, they're going to be hedging. It kind of looks like that's what we were expecting. For them to suddenly say, no, this is going to be like 2022, and actually more like 2021, which was people saying this is getting dire, this situation, and heading into 2022, they were all long. I'm trying to model it on that scenario. It's the literal opposite in terms of sentiment and rhetoric, yet we've got exactly the same factors, probably worse, probably a more tense situation for oil. So I think it's all about them. Whoever this, the people who control slow moving financial money in oil, they need to be convinced that this is a serious scenario we're in. And once they put their money into the market, that will cause, I think, very strong momentum, burst through 100, and could be a very similar situation in 2022.
It happens so often in markets that volatility, it goes down, and if you sell volatility, you make money 11 months of the year, but when it goes, it blows spectacularly.
Yeah, and I think a lot of people did make a lot of money from the actually post-2022 scenarios. Gas prices and oil prices, of course, not only did prices go down, but the volatility just got completely crushed. And I think there was a huge carry trade on being short options in gas. I think they made some headlines for a hedge fund. It makes sense, right? You're basically just fading this, awful scenario, but it's reeling its head again. And as you said, if you've made money on it, you're lazier to take the other side, aren't you?
Yep.
And you get more confidence that you can counter it.
And the other interesting bit with selling volatility, it was risk parity, which blew up, I think, in 2019. And it was the algorithms then, machine learning algorithms. They look at the past and they see volatility going down and they keep selling volatility. Well, of course, volatility can't go to zero.
No, that's very interesting. So risk parity investment. So when you look at the CFTC report to get as much information as you can about who's doing what, it's a problem because the CFTC report only has these 4 sections, and they group people like producers, merchants, i.e. trade houses, end users, majors. How can you bunch them all together and say long short? It's just really hard to read what they're doing. But it's the same with managed money, right? Because managed money has CTAs who are just essentially trading off systematic momentum signals, and you have risk parity as well as speculative investing. But the risk parity one's the interesting one. It's a bit of an annoying word, risk parity. It doesn't describe anything. But it's a key one. I think we should talk about it. And that's what I meant by the slower moving market. So how does a risk parity investment work? And try and link it to oil. So it's part of your portfolio. So you're going to have oil as part of your portfolio, your risk parity portfolio, to try and get steady returns over a year. So could you just explain that a bit more?
You're building a portfolio around, you're trying to minimize your risk. And what you're doing, typically you're doing that by picking low volatility products. And as vol's going down, of course, it works very well. But when vol goes suddenly spikes, typically we saw it, let's say 2019, asset prices going up and volatility going down, it builds around that until vol spikes.
So it's the Bridgewater thing, which they made it very popular. How do you make money in all conditions? And I guess a lot of modeling, but a lot of risk diversification. So holding a bond, stock, commodities, etc., even crypto portfolio, you're evening out the volatility of all them together.
Yes.
Weighted in a certain way will create a low volatility, steady return. But of course, if something is misweighted, you might not lose money, but you'll miss the opportunity to make money. And I think that's why a lot of hedge funds rushed in 2023 to be part of oil, because they missed a lot of the 2022 rally, because a lot of the focus was still on the energy transition, green investments. They pulled out of oil, if anything. Yet now they're all rushing back. But again, so in a risk parity portfolio, I guess you're modeling on the most recent data for what is the correct weighting.
Exactly, backward-looking data.
So there's never any forecast in what could become. Is that what you're saying? It's very unlikely for them to say, yeah, but let's take a view on this.
Exactly, absolutely. You're looking at your backward-looking data.
Yeah.
And as volatility goes lower, you build your portfolio can even get bigger around that. But when volatility suddenly spikes, that's when you're caught.
So they would be looking at oil saying, it's just not been much of a return throughout this whole thing. In terms of the backward-looking data, we're going to low weight this in oil. Simple as that, right?
Exactly.
So,
and as you saw, 2018, one of the 3 big ETFs that blew up, one of them, the XIV, had doubled. I think it doubled every year for 7 years. And then in a case of 20 minutes, it lost something like 80% of its value. But what you had there was a sort of freak black swan event where there was a hedge the algorithms could touch, which was you could either sell the ETF or you could go into the VIX. But the VIX market had shut when the bell rang in Chicago, so all of a sudden there was no hedge. So the algorithms just had one product to get out of.
So it was actually the ETF going down rather than
that was the ETF in
index
2019.
Yeah, so yeah, that's what Michael Burry warns about. As ETFs are getting so big that they're bigger than the underlying product itself. So when people rush for the exit door, it's
concentration risk.
Concentration risk. Well, this is really key, I think. Risk parity, I think it's a bit of a speculative comment to make, but they are underweighted in oil right now. And as soon as they realize they need to be heavily weighted, or at least you start to get that shift, which will probably be after the fact. So as you head towards 95, 96, maybe $100 per barrel on Brent, that's when inflation will start to bite, led by energy, and that's probably when they start to pile in. And of course, the CTAs will too on systematic signals, and then you'll get all the media hype, and then it could really start getting going. I think that's fair to say.
We see that in exactly that in gold. We mentioned that in January. You talked about gold and breaking above a key level. And when it broke above the 2080 level, asset managers were already watching that. They started to move their portfolios into gold. Then it comes across the headlines, then retail rush in and it becomes self-fulfilling.
Yeah, this is become the cycle of financial markets, really, isn't it? So, no, that's fascinating. Okay, diving into the minutiae then, Martha. Refinery margins, how are we looking at the moment?
They're looking bad. We've seen pressure in refinery margins this week, week-to-week loss of $1.10 in the M1 European margin. It's just been, the products have just performed really, really poorly this week. A bit of strength added to the margin from dated crude being a little weaker, but this was outstripped by the weakness in literally all of the products. The headliners being Gasoil and... I mean, gasoline's interesting as well because there was a little weakness, but because everyone wants to be long in this has just been bought into, and we've seen this really significant rally up again. There's been some refinery issues as well, which has added to this. So it's so biddable that when it drops down, it's just immediately supported again. I think we're looking now at, it's quite reliant on the RBOB screen performance. So I think we're going to have to see better physical, it perform better with the physical to then get that RBOB support and keep this low net pressure going up. And it's also important to look at the gas snap differential between gasoline and naphtha. This is really, really, really high at the moment, and this is encouraging players kind of buying the gasoline and shipping it elsewhere for blending. Naphtha, because naphtha, which gets blended with gasoline to make gasoline, is so low, it's just been shot, especially in Europe, that this differential is getting really high, and that's encouraging more buying in gasoline as well.
And this is, you're talking prompt prices.
Yeah.
So there's an element of, we're still in this period of focus being in the summer for the products, and Q2 contracts, April, May, June, kind of being dragged up by the Q3 buying. And I think this is what we expected ultimately, right? If they're going to be so high because they're dragged up by the Q3, it's too early for the Q2 prices or the prompt prices to reflect what's going on in summer. So naturally they do have to correct. And when you get higher crude, which we have done, I think it's kind of logical sell-off in margins, I would say. And I wouldn't say it's indicative of a weak market, but the facts are refiners aren't making as much profit. So on an outright level, where are we on refinery margins roughly on our benchmark?
It's coming in just under $7, so it's like $6.78 right now in the rolling month one European refinery margin.
Yeah, see that is very strong. I think our benchmark kind of factors in multiple sulfurous fuel oils, which is obviously not how it would pay out in an individual refiner, but we're trying to get a sense of collective refineries. And I think prompt margins at this time of the year being above $6 per barrel at least, right? And for the more complex ones, they're probably more like 8 or 9. That's very strong. And I think they're going to be running as much as they can, obviously net of maintenance, which I think we can say is probably coming to an end now. So I think, that from a crude perspective, that's still very bullish, and it's simply a retracement, I would argue.
Yeah.
You've actually put something in the notes here about propane being very weak as well. So I think it's worth a bit of talk because naphtha had a strong start to the year, then it weakens. As you said, the gasoline versus naphtha differential has now gotten extremely high. So this kind of naphtha linked with propane linked with petrochemicals, essentially we're saying two sides to the light end market, one for blending into gasoline and sometimes jet fuel, but the other side is plastics. And I think plastics kind of linking more towards manufacturing demand, and China have just, this is old news, but they've really maximized their capacity investments for petrochemicals, and I think it's kind of logical that if there's a lot more capacity to crack, naphtha and propane into petchem margins start to get squeezed, and then it kind of is bearish for the feedstock. But I think it's
we've seen the US Gulf Coast exports of propane just basically be maxed out. They're nearing operational capacity for the export terminals for propane. They're seeing about 1.8 to 1.9 million barrels a day. of propane exports, most of this being sent to the PDH units in China, which have been picking up production more and more recently. It's the attractive feedstock compared to naphtha, but with naphtha being so weak, we may see this being challenged a little. But this may dampen this demand for the US LPG, but it's still being sent out,
Well, it has to be, right? I mean, the US have all the arbitrage economics just laid out for them. They export as much as they can, really, and the arbitrage economics are looking better and better lately, but it shows that they can't get rid of it fast enough, right? And they're maximizing capacity. That's a very bearish sign for US propane and probably Asia as well, right? Because there's just plenty of supply. So I'm just trying to think of this in the context of the macroeconomic story we're talking about, but also now thinking back to about production, because the NGL market is quite sensitive to the shale oil boom in the US, and obviously it's become a net exporter largely because of the shale oil revolution. So I think it's a sign as well that despite there being a lot of strength in oil markets, if the core part of the oil markets oversupply, if there is going to be oversupply, is going to come from the US, then it's logical. Basically, NGLs being weak is logical because US, they have no restrictions on their pumping. They're up to 14 million barrels per day. They're always going to pump as much as they can in the kind of flat price environment we have now. And you see it, producer hedging is non-stop in propane markets from the US, because they're literally just trying to dig it up, drill it out, export it as quick as they can and as much of it as possible at these levels. So what I'm getting at is you might have an overall supply deficit in the world right now for oil, but it's just really been forced into that. Well, Brent Dubai, for example, is negative because Middle Eastern crude is very tight, whereas the US crude not so much. It's still tight because of the global scenario, but when you look at the relative excess to Middle East, then you think what components are in that relative excess? NGLs. And so NGLs starting to weigh down makes kind of sense. And I think as much as we are very tight and we're going to be rallying, I think, in oil across the kind of market, it makes sense that NGLs and probably naphtha are going to be under a lot of pressure as that happens, because as I say, they'll just keep producing as much as they can. It's that Taleb thing. I think I've already brought it up in this podcast. There was a big shortage in January in propane markets, as we had North Dakota freeze, and we had a lot of Permian, wellheads and things like that taking crude and NGLs offline. And he says, I've never seen a supply shortage not followed by a glut, but I have seen a glut not followed by a shortage. And I think that's the exact scenario we're seeing in NGLs, right? As much as we're talking tight and fundamentally strong things, NGL is just going to be under a lot of pressure because everything rushing back and the excess demand for US oil is not there. So how does that? I guess the other interesting point to that is if China is picking up again, and they are bullish, and that's a lot of the reason why we're becoming increasingly bullish, because everyone thought it was bearish and they're coming roaring back. You would link them quite highly with plastic demand and manufacturing demand, which is linked to petrochemicals. Yet if there's enough supply, I'm trying to think logically, if you're exporting your excesses to China can pick it up, but they want inflation, but they're getting cheaper goods, right? And so they're going to have to export a hell of a lot of that and do such a good job of buying up the feedstock and selling it selling the petchems into the open market, that actually they push their own prices higher, if that makes sense, because they've exported so much of it.
And the big problem Europe has is, we know from the data that inflation in Europe will come below target probably this quarter, but certainly in the second half of the year. And then if you have deflationary products coming in from China, then potentially the ECB could be looking at deflation at the end of the year.
Which they want probably, right, to some extent, if oil prices keep going higher.
Yes, it will balance.
Yeah,
in many ways it will balance out.
So it might be a good thing for the global economy that China do what they're doing.
Yeah, absolutely. Just the fact that China is growing again is good for the global economy.
Right.
Yeah.
But an interesting one for oil arbitrage and economics. Cool. Okay, so given all this, what's the one to watch then?
From a global macro perspective, after the strong CPI data, it's really the bond yields. If they continue to go higher, that will have a significant impact, firstly on the equity market. We've seen equities, we've talked about weeks, months even how strong equities have been. The Nvidias, the tech stocks, the Magnificent Seven. But we're starting to see some weakness there. Tech stocks peaked around 3 to 4 weeks ago. Nvidia peaked 3 to 4 weeks ago. If yields continue to go higher, and this concern about, well, firstly inflation, but also the fact that the US economy is just not slowing, then equities will struggle, and typically gold will continue going higher. Something he alluded to last week as well that's getting more and more attention is the ratio of tech stocks to commodities. And there's more commodities, people talk about cocoa's obviously gone up, but silver's suddenly roaring higher again. And that's definitely getting more attention as people clearly are starting to take some profit in the equity space.
And back to that risk parity type thing, it's not the same, but value investing, right? So you have, again, in these stock portfolios, you say, are we buying value or are we buying growth? And I think we had a switch to value over growth in 2022 as that inflation took off, but it came back again, didn't it? Because all the Nvidia stuff you're saying.
Yeah, everyone's been chasing the growth stocks.
Right.
Sorry, everyone's been chasing the growth stocks.
So maybe it could be a pivot once again.
Yeah, and the algorithms is a key to that as well. Algorithms are so big. A really good point. The bond market, FX as well, but that's not so important here, but bond and equities, algorithms are huge. And when they turn their positions, then with volatility low, then you typically will see some volatility pick up.
Okay.
And potentially spike. That's where the risk is.
And for oil, I think, Martha, we're being quite clear about it's the risk parity guys, it's the slower moving guys starting to pay attention is probably the one to watch for. So I guess that's just geopolitical headlines, right?
Yeah, and I think looking at the products as well, I think it is a bit of a case of kind of catching the knife with a lot of these things. Gasoil's been just decimated and it's down to like really low levels now. And I think in order to kind of see this picking up again, I mean, we're looking at Chinese refinery export quotas that are due soon, or kind of more secondary sanctions. We're seeing more Russian oil coming into the market, as we mentioned earlier, but I think we could hopefully be seeing some better stats draws, and once the mix, like the intermediate grade of the ARA barges, like the actual physical gas oil gets out of the way, that might incentivize people to put a bit more risk on getting long here at these really low prices.
Okay, no, interesting. And do we have a trade idea?
Yes, we do. The trade idea this week is to sell the May versus June CP spread. So the CP is the benchmark owned by Saudi Aramco, and we're looking at propane today. So this benchmark is settled with a settlement date at the end of every month. And so we're selling this in the expectation of a lower CP settlement. As we have seen in the past couple of months, we tend to see lower settlements when we're seeing high freight, which we're seeing at the moment, and when oil is strong. So there'd be things to keep an eye on. Definitely keep an eye on the strength of freight. If that starts to drop, then they could maybe afford to have a higher settlement price. But with freight high, they might have to cut prices to remain competitive, and they can also kind of afford to do that in order to cut the prices because of the strength of oil.
No, I think that's a very logical one. I guess it comes into what we're saying about the overall propane market's kind of been a wash with US excess, and actually Iran is a one, because again, when we talk of more Iran production being online, or at least getting into the export pool, which is what you say has been picking up lately, it's the condensate markets that are very reactive to that, because they produce a lot of condensate, and so that's naphtha, NGLs tend to weaken on the back of that. So I think it was last month, or maybe the month before, we got a lot of Iranian propane cargoes arriving into the FEI benchmark area, so Far East index, so Singapore and Japan and Korea, these areas, and the oil being offered was Iranian, and it all came on at once, and it really pressured the benchmark. And I think that's just quite a clear sign, right? The physical is oversupplied, not only from US excess coming back from the January tightness, but also from, and maxing out their arbitrage, but also locally and from Iran. So it's a pretty bearish picture for propane. So I think, May June CP spread, that's quite a good one. It's kind of a trending trade, right? It's been heading down already? Or?
Yeah. So this has already fallen about $1 per tonne since the start of the month. I can get the graph up now.
And in terms of how to trade that, it's that's the thing. It's propane's volatile, but it's also quite a liquid sometimes. So this is taking into pricing type situation.
So you can see this is a trending trade, kind of selling into kind of the the trend of the market. Volatility is increasing, which could mean which could be due to poor liquidity. Looks like prices may be gapping around a little. So I think this would have to be something you'd have to be comfortable taking into pricing, which, if you have conviction. But it is it's very binary with the settlement. Like, the settlement is given by Saudi Aramco, and that, that's it.
It bullets out. Yeah, it's just one day. Yeah. No, okay, that's cool. And in terms of kind of the core benchmarks, we're obviously bullish Brent. I think that's pretty clear. I think expectations of volatility picking up, I think it has to be said. So I think the average $1 to $1.50 barrel per day move should start to become more like 2 to 3 even, as we kind of heat up and get close to 100, and as the vitriol, the risk parity stuff comes in. If that does happen, I think volatility picks up. So I think that's important to say, because when you get sell-offs and retracements, it's easy to go, oh, what's happened? Is this going to trend back down? Have we reached a psychological level? But it could just be volatility picking up. And actually, you've got to zoom out and frame. Every sell-off I've seen in the last few days is very fleeting, temporary, and gets absorbed quite quickly, which is another bullish sign from a flow and positioning point of view. And I think also worth mentioning about Brent time spreads. So they are $1 backwardated-ish, or a bit lower than that, in the prompt few spreads, and people would say historically that's very high, and they are very high, but we're talking extreme environments again. And I think the way the North Sea participants are behaving, it's not even the trade houses and majors speculating. There is a lot of refinery hedging. There's a lot of genuine appetite for people to move barrels out of the North Sea, lock it in the derivatives. It's all very, very bullish positioning that doesn't care if it goes up or down. They're locking in hedges, which means it's genuinely coming from the physical market. So I think that time spread, looking back to 2022, it got as high as $5 per barrel, which is astronomical. But I think expecting us to head towards $2 per barrel at Brent time spreads is not at all ridiculous. I think that's the environment we're in. And even though we've got weakness in products lately, refinery margins are still above $6, maybe even $7 per barrel. So they're not going to stop buying crude as we come out of maintenance. So I think it's all looking bullish in that point. And then we actually put out a poll, which wasn't actually very well participated this time. I'm not sure why, but we said, could the 2022 melt up in Brent flat price repeat itself this year? Marginally, 50% said yes, 43% said no. So even though it wasn't that many people that voted, that is indicative of the market sentiment. People aren't really expecting it, and there obviously are bulls out there, but if this was 2021 going into 2022, that would be 90-10, and we're in exactly the same scenario. So if anything, worse in terms of supply, and demand outlook looks good. So I think that's going to be very interesting. So I think we've unpacked a lot there. There's a lot going on, and there will continue to be a lot going on. And thank you, listeners out there, and join us next week for more of the same. Thank you.